Mr. R. Gandhi, Radhika Rao, as well as Devang Shah joining us. Devang, apologies for the previously calling you Devang Mehta. But yeah, Mr. Gandhi, let me come to you and get your views, because apart from the fact that the RBI has gone ahead with the rate cut, the change in the stance as well, one of the key policy changes, of one of the key proposals that made, that the RBI's comprehensive review of gold loan regulations, that's one of the things that they've spoken about, and looks like that will increase the competition in the sector. What would that sort of a guideline or comprehensive guideline mean actually for the entire space?
Yeah, gold loan has come to stay, in the sense that it used to be in pockets, mostly in the south or southern part of the country, but now it is increasingly throughout the country. There's attraction for gold loan is there, and the all type of institution, whether you are a bank, big bank, small bank, or a NPFC, everybody is gearing, because it becomes very easy in terms of collateral, obtaining collateral, and it is highly flexible in the purposes for which the gold loan can be taken, can be anything from consumption purposes to productive purposes, and that way it is a highly flexible loan type. So that is looks like RBI has realized that this needs to be made good use of with appropriate checks and balances. And they're in the current situation, different institutions, because there's some were doing it for long, some have latest entrance to that sector. So there is kind of different rules and practices followed by different type of institutions. That's why RBI is targeting for harmonizing the gold loan related regulations, both from prudential point of view and also for contract point of view. But that is a good augury, because it is a very good tool. If it can be properly utilized, it can help borrowers, be it for supporting consumption or for productive purposes. That's a good move, in my opinion.
Right. We also have with us Radhika Rao. I want to understand from you one thing which has not happened in this policy, at least in terms of some announcement, is liquidity. There is a comforting commentary which is coming in from Reserve Bank of India, but expectation of CRR cut has not happened. What are the steps you think Reserve Bank of India still can take in coming weeks or months to ease the liquidity situation?
Yeah, thank you so much. See, on liquidity, I think it's very clear what has happened in the past 4 months, which is that the central bank has not necessarily waited for the monetary policy meeting. I think most successive governors have kind of tried to demarcate the two, which is that policy stance. And today, I think the Governor Malhotra also mentioned again that the stance that they have come up with, that shouldn't be equated with what they're going to do on liquidity front. So to come back to the points, certainly they're not limited by the monetary policy meeting. You've seen a lot of announcements, everything from open market operations to swaps to the VRR announcements coming on a very regular basis, and just by way of press releases. So that I think is going to continue. You had faintly, briefly mentioned about the CRR cut. I think that happened back in December. I don't think they see the urgency to do that as of now. With the measures, the ad hoc operations that have been undertaken, if you see the banking system liquidity, it's already in quite a strong surplus. So I don't think there is any urgency. Either way, taking it below 4% hasn't happened in normal times. It requires extraordinary times when it's taken down further. So I don't think they see it at this point. And going into the new fiscal year, like some of the other commentators mentioned as well, you're actually going to see the RBI's dividends come into the fold, and so that's going to add to surplus. And then the central bank has already mentioned that they're going to keep liquidity in a comfortable position because they want policy transmission, and I think that's quite obvious in their commentary as well as their action. So overall, I would think again more is likely to come. I mean, anywhere between 2 to 3 trillion more of liquidity support can be expected, just to tide over, say, frictional shortages, like advanced tax payments or government spending delays and so on. And overall, back on the policy, the stance change and the rate cut was along our expectations. But I just want to add here that that does not mean that they're going to cut at every meeting that they have. So certainly some in the market might take an overtly dovish view that jack up more rate cuts. We wouldn't be in that camp.
All right, but Devang, help us understand that what the bond market maybe is penciling at this point in time and where the 10-year yield for the Indian markets are seen to be headed, because RBI has said that they are expecting further pressure on the currency front, and at the same time, globally, of course, we are seeing the spike in the bond. So help us understand what are the projections for Indian bonds?
Yeah, thanks. I think if you actually look across today's RBI policy, as per us also probably, RBI has delivered everything what markets wanted. Markets were looking out for some bit of change in stance. Markets were looking out for a policy rate cut, and markets were looking at the direction. Is RBI confident that the next move should be lower? I think Sanjay Malhotra, governor, has actually spelled out quite clearly the next move can be lower or a pause. But looking at the current environment where there's a lot of uncertainty, and specifically, I think if we look across at the global uncertainty environment, if the tariffs are supposed to continue for a slightly longer term, it will lead to slower growth in India. It will actually also can lead to disinflationary forces to probably start in India, which can lead to lower inflation. Both are very, very good recipe for rate cuts. And that is why we believe that there is a possibility that there can be additional 25-50 basis of rate cuts. With those getting penciled in, I think the bond markets and today's dovish policy, I think bond markets can move towards a 640 range in the next 3 to 6 months. Our perspective is that, yes, currency is somewhere an important variable which markets will be looking at. I think not only currency, people will also look at what's happening on US bond yields. US bond yields in the last 5 days are up almost 60 odd basis. So a combination of US treasuries as well as currency will be kept in mind. But because of the local macros, which is lower growth and lower inflation, I think yields should start inching lower or trending lower towards 640. They can go in the band of 640 to 640 in the next 3 to 6 months.
All right, one final word I want to have with Mr. R. Gandhi. Do you think that Reserve Bank of India has been thinking in the direction of regulating gold loans, particularly because you would have seen the notifications, the directions which has been there to NBFCs? Do you think it is going to be slightly stricter, or you believe that it is more of a formulating the guidelines or setting the fence right?
If you look at just a couple of months before RBI had come out with its intention to bring better clarity on gold loans related regulations. The certain practices which which it has seen on the ground is not good for the customers' protection. So that would mean that the new regulation will have a slight edge of a little tightening. That's what I would believe, because of in gold, more than prudential part, that which anyway should be there, but it is more the contact regulation which is important, especially when it is targeting that every type of institution is going to be encouraged to give to give a gold loan. That would mean that in that case, the contact policy will have to be tightened. So that part I would expect a tightening, whereas otherwise enablement in terms of expanding for the purposes for all which gold loan can be taken, that could be a kind of easy.
Right. Radhika, let me come back to you and actually get your view, given the fact that, yes, we did speak about liquidity and the mention of that in the policy, that the fact that this time he did give a comforting note on that and did not dwell too much into the liquidity conditions. But I wanted to understand how do you assess the future roadmap going ahead when you talk about the MPC and the policy making in India, given the fact that you are actually faced with global turmoil and it's very difficult to gauge which side of the fence will the growth actually move. Right now, the RBI has moved their projections about 20 basis points lower. But what's your projections for the growth going ahead, and how much of a rate cut, rate cut possibility are you seeing for the rest of the year?
I think before we take the path going forward, I think we should take a step back. See, there are three big changes that have happened. We are only 1 quarter into the calendar year 2025. But if you've seen, there have been three big changes. First of all, if you see the policy itself, last year we spent bulk of the year being on hold. Because inflation, because of higher food and supply shocks, we had seen inflation being quite sticky. And this time around, inflation has begun to come down. The second one is that liquidity was, either baseline negative or near neutral. So we hadn't really seen a surplus, and then we've come back now. We are now looking at a surplus. The third being the currency itself. The currency was certainly trading on a much more weaker note, partly because of policy discretion, but generally keeping on a weaker note against the dollar. And here in this year, we have seen, in fact, in the past month, that the dollar rupee has moved down briefly below the 86 mark, but now, of course, because of global uncertainties, it's around the mid 86 mark. So overall, the preconditions and the background has changed. And I think what we're heading towards in the next 6 to 12 months is basically all countries, India included, is going to see an extremely difficult global environment. Now, what implications will that have on Indian policy making? See, the announcements that are being made are certainly much more inflationary for the US. But I think the impact on emerging markets, especially Asia, including India, is going to be much more disinflationary. Crude prices are low. Certainly, and growth is at risk, especially the growth that is exposed to global shipments and trade. So India exports to the US are ballpark about 2.2% of GDP, so not that big when we especially compare it with other regional players. So there's bound to be impact. Our own analysis is about 50 basis point of growth impact because of the tariffs. So that's not highly significant if you compare against some of the ASEAN neighbors, for example. So a difficult global environment, growth risks, and inflation downside. So this certainly provides a much more conducive environment for any central bank to lower rates. But I would be a bit cautious. Again, like I mentioned, just because there's a stance change does not mean that there's going to be a slew of rate cuts from the RBI. I think they will be looking at a few things. What happens to what the Fed does, what happens to global yields, what happens to the currency, and inflation as well. Now, in the next 3 months, we're going to see heat waves. So certainly food is going to be, I think, one part of the inflation that's not going to correct very sharply. So they're going to look at a whole lot of things. So at this point, we still have about 50 basis point rate cuts in the pipeline. We are not necessarily in the camp, looking for 75 to 100 more from here, because there are a lot more moving parts. So that would be our take overall.
All right, Radhika, with this, we let you go on that. And I would also like to thank Devang as well as Mr. Gandhi for taking the time out and speaking with us on the special coverage of RBI MPC meet outcomes. So definitely a 25 basis point of rate cut and a slew of other announcements being made. The markets have given their verdict, but as of now, they are sitting at the day's lowest point in this uncertain times and will, of course, seem to be replicating what's been happening globally. But with this, it's a goodbye from me and Cheryl as well as Ankur on this special coverage. Thank you so much for tuning in, but don't go anywhere. But just after this quick break, buy now, sell now, we'll take the action here.